Hello, this is Jim Joe. It's Saturday, October 17th, and we're reviewing the Kevlar trade. As I ended up recording just a couple of days ago, we're still, I think, in just great position. We're right in the middle of what some people used to call the Valley of Death. I actually run this trade to end up trying to manage in this position. Because if we either move up substantially or move down, I'm in good position. Yes, the theta is a little bit lower, but what happens is that the theta does end up growing throughout the trade. Just a quick recap. If you remember, we have a 75-point wing on the upside. It's an iron, broken wing iron condor or iron butterfly, and a 100-point put wing on the downside. I'm going to be traveling this week, so I won't be able to end up recording as many videos, but what I did want to do is I wanted to end up going through some of the thought process on what happens if. I think it's really, really important that you know exactly what you should be doing if the market ends up moving up or moving down. So what I did is that I put together and I did some analysis, and I have a couple of trades that I would end up using if we ended up moving higher, and a few trades if we ended up moving lower. Let's also take a look at what would end up happening from a day perspective, okay, because this is just an expiration graph. So I end up liking to take a look at the day graph. This is the 7-day graph, so I end up taking a look at, 1, 2, 3, 4 weeks. I'll also end up going and I'll take a look at what the maximum number of days are. And the maximum days is 15, so it's almost a little bit more than 2 weeks between each of the lines. One of the things that you'll see is that the slope of the line goes from upper left to lower right. When the slope of a profit graph goes from upper left to lower right, your delta are always going to be negative. Now, here's the way you can see how your deltas and your trade will morph every day. I know that some people like John Locke like to call it trending of your Greeks, but you can end up seeing that if I end up taking a look at the steepness of the line, every single line every 2 weeks, we're going to get steeper and steeper and steeper, meaning that my deltas will naturally get more and more negative. I like to have that going into a trade because if you remember, if the volatility goes up, that means that we'll end up moving further away from the expiration graph. So for example, let me give you an example so you can see this. If we ended up moving down significantly, and let's use the center of the butterfly as an example, you could end up seeing that the profit would end up going to $187 or $186.92. You can see that number right here from the date. When I end up holding my cursor over, I can never hold it over the exact same spot. But you can see right there, it's close to $187 or so. What will end up happening is that if we drop this 4 or 5%, rather quickly, obviously the volatility would end up spiking. And there's no easy way to end up saying what your exact, P&L will be, because when we take a look at something like any tool, and we're going to use Thinkorswim's volatility, where we're taking a look at having the volatility jump from 15 to 20 to 25 to this, and the yellow line is 35%. So if we come back down here, you can see that as volatility goes up, the entire trade will end up losing money. Why? Because in the expiration graph, the center of the butterfly was right here at 1950. This is a theoretical exercise. This will never be totally accurate, and here's why. What this ends up doing, what any tool ends up doing, is that they take each of the implied volatilities for every one of the strikes and they move them up the equivalent amount. That implies that there's no change in the skew, which there always is. So therefore, your numbers will never, ever be exactly the way they end up saying. And one of your jobs as a trader is to end up realizing how that ends up moving. Okay, but I just wanted to end up going through that with you. With that, let's go back to the day steps. And what I wanted to end up doing is I ended up showing, if I show you the day steps, what I'm going to do is, remember I told you how the delta would get more and more negative? Well, let me actually show you that. Instead of plotting the open P&L, you can come over here and you can actually plot the delta. And you can see that as time goes by, not only at the money, but you can see in the entire curve how the delta will get more and more negative. Now, one of the reasons why I like this trade is that yes, as we go down, the deltas get more negative. That's nice. It gives me plenty of room, maybe 4 or 5% before my deltas actually become positive on this. So it's an easier trade to end up managing. With that, let's go back and take a look again at our trade, and I'll start with the expiration graph because I know that's easiest for most folks. If we end up moving up, a couple of things end up happening. As we get later in the trade, our theta will become negative. Right now it's positive, so there's not a lot to worry about. But if we end up going very positive, you can see that at some point we'll actually start to end up making money. But if we end up getting out here, I need to take a look at, well, how do I end up protecting myself against this? Well, there are two ways to end up doing this. The first way is to take our call, which is at 2,000, and remember, this was the SPY call, one SPY call. I've represented it here as 0.1 SPX call because the ratio is 10 to 1. So what I can end up doing is that I can actually roll that call back. You can see that this is a 50-point roll where I would sell the 2,000 and I'd buy the 1,500. I spend $37 on that. That's equivalent to getting $13 if I was to sell the put spread, right? Because buying a 50-point call spread versus selling a 50-point put spread is pretty much the same trade. I realize that there's certain differences, but theoretically it's pretty close. So it's about 50 minus 37, so it's getting almost $13. And if you click on this, what you'll end up seeing is that yes, we end up having more capital being used, up to almost $4,200. Remember, I ended up planning up to 5,000, so I'm fine with this. I could go back further, but I'd want to end up leaving that extra capital. What this ends up doing is that this ends up helping to increase my deltas. You can see that I go from minus 1.3 to 0.4. You can see that I also help my theta. So and I also have brought up the sea of death here, or what I would end up losing if I held to expiration, which we never would do. But it's helped my trade somewhat. Okay, that's one possibility. One of the things that I always end up doing, that I like to end up doing, is I like to take a look at what my adjustment looks like by itself. So if I unclick everything and just click the trade, you can see this is what I'm doing, right? I'm buying this put spread. I'm buying this call spread. It looks like selling a put spread also, right? I'm buying the 1950 and I'm selling the 2000. Okay, the next trade, that I ended up taking a look at was to actually change the structure. Here's one of the things that I like to end up doing. I'm short the 1950. I'd like to roll that up. So instead of being short the 1950, I was short the 1975. I'd get more money for that. But the problem is if I just rolled this one short call higher, it would end up substantially increasing my margin. So if I'm worried about the market going up, what I'll end up doing, yes, I'll roll this short call up, but I'll also roll this long put that I have at 1850 up 25 points. So you take your long put, you roll it up 25 points. You take your short call in the iron condor and you roll that up 25 points. If you put those two together, it's an iron condor. Okay, and you can see right here in this iron condor that I have already set up, I am buying back the 1950. I am selling the 1975 on the call side. So there's my roll up on the call. Here's my roll up on the put. I'm buying the I'm selling my long 1850 and I'm rolling up it to 1875. So if I click on this, you can see what I end up doing. I've rolled up my short put and my long put, and I've rolled up my short call. You can end up seeing that this ends up helping substantially. This gives me a lot more theta. It doesn't a lot more delta. It doesn't hurt my theta as much. It's a little bit too early in the trade. I like this adjustment when it's much later, and the reason I like it later in the trade is because what would end up happening is that this T+0 line, the way it would morph from where it currently is to the expiration, I don't want to have to wait 2 weeks for that. If it was already later in the trade, it's a wonderful adjustment, probably a little bit too early. if I could also do both of them. If I thought that the market was just starting to rip raw higher, this would be, a fine adjustment. We'd end up have plenty of time left on it that if it pulled back. So that you can also end up seeing what just the iron condor looks like. You can see here that what I've done is I've rolled the long put up and I've rolled the short call higher. And so basically what I'm doing is I'm buying an iron condor to do the roll. I like doing the rolls in pairs like this and putting them together. Single trade, don't have the chance of getting, stepped or legged out of one side versus the other. So it's my preferable way to end up making adjustments. So those are my adjustments on the upside. If we were to move down, first of all, I don't have to worry about if we move down in any way, shape, or form. If there's a little bit of a drawback, it would have to be substantial. If we end up moving substantially and the skew remains relatively steep. Now remember what put skew is. So I'm making an assumption here. And put skew is, let me come over to the trades. Put skew is taking a look at the implied volatility over here, and it's saying, well, if we were to, and let's just use an example. If we were to end up rolling the, I'll just use the example of rolling from 2000 down to 1950. You can see what we would be doing is that if we were buying the put spread, we would be buying a 1640 implied volatility, and we'd be selling almost an 18. So it's a 1.5 difference. I want to end up getting at least a point on 25, at least a 1.5, or preferably even a little bit more on a double, meaning 225s, on a 50-point roll. So since it's where it is right now, the implied volatility is, low enough, the skew's steep enough, I'll end up going with the verticals, but I would have to end up changing that depending on what would end up happening in terms of the implied volatility. Now, I have one of two choices when I end up rolling. If the market's moving down and I don't think that there's a chance that we're going to end up blowing through it and having like a 10% correction, I'll take my short put and I'll roll that down. And let me show you that. That's currently trading at $4.75, and all I did was that I rolled it down. See, one of the reasons why I like this to be my first adjustment is that because I start with a broken wing butterfly, 75 points on the upside and 100 points on the downside, if I end up using this 25-point vertical, now I have an iron condor, or split stripe butterfly, some people like to call them, of 75 points on each of the wings. I am even in terms of my structure. My entire structure is below the money. You can end up seeing that my T+0 line gives me just enormous amount going down. The other option that we'd again, sorry, I always want people to end up seeing this, is this is basically what we're buying, right? We're buying the put vertical where we're buying the 1950, selling the 1975. Okay. The other adjustment, if I am much more afraid, or if the skews are much more attractive, I could end up taking this long put that we have at 1850 and rolling the long put up to 1875. If I check on that, you can see now I still have the butterfly. I don't have the structure. It is much cheaper. Okay, you can end up seeing, and naturally these things are going to be much more expensive if we end up going down. So don't think that my planned capital will drop to, 1575 here. I know that my planned capital might drop to 1700. I do like the fact that I'm taking money off the table when the market's getting riskier, and no matter what ends up happening, I can end up, managing my loss. If things continue to go, if we were down here for a while, if I ended up buying a second one, now this would not be above the zero line if we move significantly down. But you can end up seeing that if I end up putting them both on, I can have a very strong risk management if we end up moving down. Those are my adjustments. Last thing, again, what I didn't show you was, this is what we would be buying on the lower one here, a much lower put vertical, you can see that the cost is only $260, right? You can see the $2.60 here. So naturally, the blue line would be minus $260 because it's only a one lot. Okay, that's why it's easier to model in one lot. So I do that often. If I put them both on, you can end up seeing it's a stair step. If I put the whole thing on again, you can end up seeing what the adjustments are down. Anyway, that's my adjustments both down and up. This was a much longer video because I wanted to be able to end up telling you the thought process behind the adjustments. I am going to be traveling this week, so I won't be able to end up doing as many videos as we go through. But hopefully this gives you a good idea how to end up planning if the market moves up or down. Thank you very much. As always, if you have questions, shoot them to Tom Nunemaker or myself. I'd be more than happy to end up helping. Because I'm traveling again, I'll be a little bit slower on my responses this week, but Tom's always very quick. Thank you, everyone.